Hey everybody! Today we're going to give you a sample of a free course we have available on our Payments Professor website. It's a free course that covers the different payment channels available in the United States. It's designed to educate everyone on what payment channels are and how they work. This particular episode is going to focus on alternative payments. Enjoy! Hey everybody, and welcome to the Alternative and Emerging Payment section of the Introduction to Payment Channels. First of all, let's be clear that this section isn't really about payment channels, as the only payment channels in the US currently are ACH, cards, cash, checks, real-time payments, and wires. But there are other payments that we hear mention of enough that I think it's important to have some understanding of what they are. Things like blockchain, cryptocurrency, or maybe even things like PayPal and Zelle. So let's get an introductory level understanding of what it is meant when we hear alternative or emerging payments, or any of those things I just mentioned. For example, PayPal. PayPal came about because of the need and interest of individuals to find low-cost ways of moving money between themselves and merchants, especially in an online environment. PayPal could be considered to be a payment system and operates in a low-cost and quite efficient manner, but they're not a payment channel. Essentially, PayPal operates as the interface between the payer and receiver handling the payment process and the other banking functions and settling of the transaction, and they use either wires or ACH between the payer's bank and the receiver's bank. PayPal is a service provider. They provide the service of offering ways to collect and make payments. PayPal makes use of other payment channels. PayPal can handle multiple currencies and even card payments. But the key difference between a PayPal transaction and that of a conventional bank transfer lies in PayPal's role and even their obligations to those of a bank. Banks are very highly regulated and operate with very sophisticated security tools and even capital adequacy requirements. Now, PayPal as a service provider has some requirements too, but they're different. If something goes wrong with a payment and the payer has complied with the bank's requirements, any loss or problem is generally, not always, but generally absorbed by the bank. While PayPal may have excellent controls in place, it's not considered to operate under the same restrictions and regulations because of its lower cost and simpler interface that appear to be more consumer friendly. That could be a matter of opinion. I actually do believe they do a great job. Now, provided there are no failures and intermediaries, everything goes great. You've also probably heard of Zelle, very similar to PayPal. But think of Zelle as a service available to financial institutions. It's offered by a company called Early Warning Systems. It allows users to send money with a phone number or an email address. But for financial institutions to use or offer the Zelle network, system, or service, however you want to look at it, but it's not a payment channel, it actually uses other payment channels to actually move the funds, and that institution has to sign up for the Zelle service. Currently, ACH and card payments are being used. Now, what about blockchain and cryptocurrency? Well, let's first of all talk about a ledger. What's a ledger? A ledger is a principal book, or think of a computer file for recording, tracking, totaling economic transactions per account and even by account type, with debits and credits in separate columns and a beginning balance and an ending balance for each account and the activity that takes place within it. It's how the banking industry keeps track of how much money is in your account and how that money gets moved from one point to another. Most existing payment systems, whether bank-centric or non-bank intermediaries like PayPal, are dependent upon the validity of secure internal ledgers to track deposits and payments. The validity and security of ledgers is dependent upon the security and indirectly the reputation of the keeper of the ledgers, which is traditionally banks. With the advent of modern computer technology and even the internet, things have really changed. See, shared open ledgers have become an alternative to secure private ledgers. Secure private ledgers being what the bank does. This is where we get the concept of blockchain. Instead of recording deposits and transactions in one or just a few secure ledgers maintained by trusted intermediaries, such as financial institutions, blockchain transactions are recorded simultaneously in a large number of open shared ledgers that are encrypted so that previous transactions cannot be modified and only users with proper security key controls can access accounts and order transactions. Plus, there's security in doing things this way. Having all these different computers as part of the system, even if one copy of the ledger is hacked or modified, the fact that it no longer matches or agrees with all the other ledgers means it's no longer accurate. We know that there's a problem and to stop. Blockchain technology was initially used to create cyber currencies or cryptocurrencies, such as Bitcoins and Ether, which combine the currency and the payment system in a single system. But it's important to recognize that while cryptocurrencies use blockchain, not all blockchain applications are cryptocurrency. Blockchain has other uses as well, such as where transactions need to be recorded and reconciled. This can include property records and transfers, even international letters of credit. But guess what? We're focusing on payments in this series. I just wanted to throw that in there. But you mentioned cryptocurrencies there, Payments Professor. That's right. What is a cryptocurrency? In its basic terms, a cryptocurrency is a digital or virtual currency that is secured by cryptography, which makes it nearly impossible to counterfeit or double spend. Many cryptocurrencies are decentralized networks that are based on blockchain technology, not all. A distributed ledger enforced by a disparate network of computers. In other words, there's computers all over, a large network of them too. The defining feature of cryptocurrencies is that they are generally not issued by any central authority, rendering them theoretically immune to government interference or manipulation. A person can acquire cryptocurrencies like Bitcoin by purchasing them with a conventional currency or providing goods or services with the payment denominated in Bitcoin. The holders of Bitcoin can then transfer them amongst other Bitcoin holders using blockchain technology. The more blockchain users there are, the more secure the system is, as the ledgers of all users must agree to validate a transaction. If everyone used Bitcoin, it could be very difficult for conventional currencies or payment systems to compete. But not everybody uses it. And a lot of that is because it's not backed by a central government. And these are a couple of aspects of cryptocurrencies that make it highly unlikely for it to become, well, that widespread and taking over the other channels. Now that's it for alternative and emerging payments. There are definitely others, but for an introduction, the thing to remember is how does the payment actually move, as again, there are only the 6 current payment channels: ACH, cards, cash, check, real-time payments, and wires. All of these other new technology and payment options, well, they're just really piggybacking or riding along one of those payment channels, like what we saw with PayPal and Zelle. I hope you enjoyed that. If you would like to see the full series, well, it's free. It's free on our website. Just go to paymentsprofessor.com and sign up for the free course. We also have additional courses available, and more are coming and in production at the moment. And we have information that's there, and it's available to be able to aid you, the payments professional, in learning everything you need to know to advance your career, get that raise, maybe even that promotion, and to do so while protecting your financial institution, your fintech, your business, and your customers. If you have questions, you got comments, as always, please feel free to email me, Kevin@paymentsprofessor.com.